Welcome back to another episode of Portfolio Builder. This episode is going to be on debt management. Simple disclaimers that I'm not a CFP, not a CPA, and not a financial expert. I'm just a guy on YouTube trying to create educational content to hopefully address some of the gaps in financial literacy. For today's topic, debt management, we need to kind of break it up into kind of two topics. The first being good debt, the second being bad debt. To start things off with good debt, this is going to be leveraging student loans to get you a degree that hopefully opens up new opportunities, higher paying jobs, that is going to kind of give you a return on that investment. For me personally, that was using student loans to leverage a medical doctorate degree, to complete residency, and to earn income as a physician. Other people can do that to go to dental school, law school, MBA, or something else. Other people don't do the traditional routes. They might go to trade school and leverage that to be a plumber, an electrician. That's going to allow them to hopefully start their own business. Whatever you decide to do, however you decide to leverage student loans, just make sure that it is going to get your return on investment. Not everyone needs to go to college, but that's not the topic of this video. The other example of good debt is going to be a home mortgage. Everyone needs a place to live. If you decide to rent, that's completely up to you. But for me personally, I want to build equity, and so what I do is I bought a house. I have a 15-year mortgage. Whether you do 15 or 30 is up to you. But for me, each month that I pay my mortgage, I'm basically building equity inside my house. So when the time comes for me to move to sell this house, the equity that I built up in my home, I can then turn that into money into my future home for a down payment. I can then take some of that money out, just get a new loan, use that as leverage, and then take that money that I don't want to put back into the new house and invest in the stock market. That is personally what I plan on doing when I end up selling my house in the future. But again, this is just an example of good debt. Good debt is a way that you can leverage monthly payments to purchase things that you otherwise would have not been able to pay that full price. Whether it's a house, whether it's student loans, that part's kind of up to you. But understand, good debt at a low interest rate is something that should not be kind of shunned. Just because you're going in debt, just because it's earning interest, doesn't mean this is a bad kind of investment. This is hopefully going to be investing to give you a return on that investment that is going to be higher than the interest that you're paying. That brings me to bad debt. Credit card usage is high. The debt that is kind of in the US on credit cards is huge. Buy now, pay later is something that I have mixed feelings about with kind of companies like Affirm. But the hope is that those are going to have low interest rates for that period of time, and that's going to allow people to hopefully pay them down and kind of use good debt as leverage. And what I mean by that is making purchases that they could otherwise pay for on hand, but just going ahead and electing to pay it over small amounts over a set number of months, knowing that they are just going to use that money to hopefully invest and then pay it off when the time comes around. But bad debt is something that's going to be at a high interest rate. So credit card debt could be higher than 10%, could be 15%, but those payments are something that should be the focus of your attention if you have it. If you are wanting to invest in the stock market, but you have debt that's earning kind of 10, 15% interest, that is something that you should be focusing your attention on first. Paying down that principal so that you no longer have the interest payment is actually making a return on your investment. It seems counterintuitive, but there are a few things with a guaranteed return on investment in the stock market. If you go ahead and pay down that debt that carries 10 or 15% interest due to credit card payments, that is a guaranteed return on your money of 10 to 15% just by paying down that principal. So rather than risking it in the stock market, which is not a guarantee, you can just pay down that principal, which is a guaranteed return on investment. Then once that debt is paid off, you can use that money that you otherwise set aside for paying down debt to then invest in the stock market or for leisure, whatever you choose to do with your budget. But that brings me to how to pay down debt. There is the debt snowball, there is the debt avalanche. My personal favorite is the debt avalanche. That means that you write down all the lists of your debts, the principal amount, the interest, and regardless of the amount, you pay down whatever has the highest interest rate. You want to pay down that fastest so that you can pay down not just the interest each month, but the interest plus part of the principal, so that number can shrink. That's going to get you the highest return on investment. Generally speaking, those could be some larger principal payments, and that it's kind of like dieting. takes a toll on you if you don't see any progress. And so some people prefer to do the debt snowball. While they might end up paying more money in the long run off of interest, they pick out the smallest one, pay that off first, get these kind of wins, these kind of moral victories, as well as financial victories, and they use that to snowball into the next one and just keep knocking them out. The third option is just doing a hybrid. Maybe you kind of identify your highest ones that you want to get attack first, and then mix in some smaller ones just so you get those victories in between. How you choose to pay down your debt is completely up to you. Just know that if you do the debt avalanche, you're probably going to pay less money towards interest, but it might be harder to stick with just because those might be larger amounts that you're trying to pay down first. It might take a while before you pay down your largest kind of debt holding. The other thing is going to be the debt snowball. And so that one, you might pay more in interest, but you'll kind of get the little moral victories along the way and hopefully stick with it. But however you choose to do it, just find one that works best for you, because ultimately it's your life. You know yourself best. You know what you're going to stick with. And I'd rather you pick something that you're going to stick with rather than something that maybe makes more sense from a purely analytical standpoint. We're emotional creatures. We're not only analytical, we're emotional. And so finding a balance between the two is always important. But if you like this episode, don't forget to like, comment, subscribe, hit that alert button so you know when the next video comes out. But as always, thanks for listening.